on average, you might want to look at 125 deals or so to be able to find one that works. There's usually a lot of sifting through it, right? And you're not going to go and spend 2 hours on each of these 125 deals. Otherwise, you're spending 250 hours and you're not going to have time to do anything else, right? So for us, it's really about starting wide. When I say starting wide, it's starting from a very macro perspective. Let's look at the market, right? On a market level, is this a place we want to be? Well, we could even look at it, is this a country we want to be in, right? We know we're only in the States, but then it goes into, well, is this a state that we want to be in? And then it goes into, is this a city within that state that we want to be in? Is this an MSA that we want to be in? Is this a market that we want to be in? And then you get more granular.
Welcome to the Wealth Through Real Estate Investing podcast, your source for real-world strategies focused on creating long-term wealth, cash flow, and financial freedom through real estate. Through guidance, tips, and stories of highly successful real estate investors and thought leaders, we provide you the tools to succeed and reach the lifestyle you always wanted. And now your host, Dwayne Clark.
Hello and welcome to the Wealth Through Real Estate Investing podcast. This is your host, Dwayne Clark. And today we have Dylan Marma. Dylan is a multifamily real estate investor and principal at Rand Partners. Dylan, thank you so much for joining us on the show. And how you doing, my friend?
Thanks, Dwayne. It's my pleasure to be on the show. Excited for today's episode. Doing really good.
Look forward to it. Happy New Year. It's a big year, 2020. I know you guys are working on a tremendous amount of projects, so very interested to hear. But before we kick things off, would you talk a little bit about your background, your current focus right now, and how you kind of got started?
Sure. So I've been working around multifamily real estate for about 2 years now. So there's been a lot learned and a lot accomplished in terms of just for a short period of time. It's been a great ride. As far as where I am in life, I'm currently 25 years old. I initially I had my whole curiosity sparked with the entrepreneurial space back when I was about 19 years old, and went through a little bit of a trial and error process, working on all sorts of different businesses and getting into sales and selling things from anything from LED light bulbs to selling cologne at flea markets, you name it, right? I was going out there and just really trying to do something that's going to allow me to run my own business of some sort. And I really got into reading big time. I'm a huge reader to date. I try to read roughly a book a week or so. And through a lot of my reading, through a lot of my learning, a lot of what we could consider to be almost like virtual mentors that you're studying, I was able to, a lot led me back to real estate. And I started off in real estate by working for a real estate investment education group out of San Diego. So I grew up in upstate New York, left out to San Diego, spent about 3 years out there working for a group. And I was the youngest sales manager with the team there and learned a whole lot about real estate in all different fronts. I started to buy my own single family houses in different areas, not in San Diego, but out in better cash flowing markets in the country. And I saw that I needed to get into a vehicle that, number one, was going to challenge me in a way that was exciting and in a way that was going to allow me to grow in a space for the rest of my life. I think there's a lot of merit to that concept for anybody out there, right? You don't want to be doing anything that you're ever complacent in. So I saw that, number one. And then number two, I think I had ambitious goals to find something that's truly scalable and that provides for you in a certain lifestyle. So, a lot of that led me back to multifamily, and also multifamily tied together with syndication and being able to work with investors, being able to provide investors with attractive returns. And I think the whole experience of that really just excited me. So that was really the start of it. And then started off with a small 21 unit up in upstate New York, actually Troy, New York, right near where I went to school in SUNY Albany. And then from there, I got into, I moved out to Atlanta for a period of time after San Diego and spent about 6 months out there learning. I grew my own meetup, and I was just actively networking and really, I would say, seeking to serve and just seeing how I could add value to those around me, seeing how I could, create strategic relationships. This is really a team sport. And I was very fortunate to be able to link up with the guys here with Rand Partners. My partners, Jake, Gino, and Mike, those guys had started the business back in 2013 just through purely buying and holding assets. and they had a little bit over 800 units at the time when we started out. Being able to take that foundation that we had in place of a way of being able to buy deals effectively, being able to improve deals, being able to self-manage the assets, and then tying that together with the reach that we have through the podcast. Jake and Gino started the podcast, Wheelbarrow Profits with Jake and Gino, and they had a great reach. They had a great audience of people built up that had been, I would say, almost some being eager to invest alongside them just by hearing their story and having that connection that was built over the years. So I think we really just had a great foundation to build off of, which is a large reason why we were able to build quickly in the last 2 years. And now we're currently at about 1,600 units that are currently owned and under management. And all around, it's just been a great experience. Keeping busy, a lot of fun.
Yeah, you have a tremendous story, because one thing I really like is just kind of your entrepreneurial spirit, that you just went from, looking to find what your niche was, and no matter where it was, you travel to different states just to be able to, where some people, they'll just kind of settle in, and not go anywhere, or they'll try something that don't work out that way. They'll just kind of, get away from it. But you just kept pursuing to say, this is what I want to do. And if it means, hopping on a plane to move to a different state to ultimately, hook it up, I would say one of the top brands in the industry right now, Rand Partners and Jake and Gino, and you guys are building tremendous portfolio and making a huge headway into the industry. As far as kind of your role, are you have like a specific role with the group that you normally handle on a day-to-day basis?
So I wear a lot of hats. I say oftentimes that my main focus is acquisitions and investor relations, but I think it all bleeds over. We're such a small group at this point in time. There's the four of us, but the day-to-day office is usually me and Mike Taravella. Mike Taravella is our asset manager, and the two of us really are spending a lot of the time plugging away with looking at new deals and working together in asset management. I know, for instance, tonight we have a bunch of investor calls where we're doing our quarterly reports for investors and doing webinars where it's going to be us two and Gino on there. So the day-to-day is a lot of just us in the office, just doing all kinds of stuff from, the acquisitions, asset management, dispositions. I think one thing that no one realizes that when you're getting started is that you're actually really fortunate, because you can be so narrow focused. There's a lot less to juggle, that you have an extremely large amount of time to be able to underwrite deals, right? And that depends. Some people are working 65 plus hours a week, and that leaves you limited. But I think when you're getting started, it's really just finding the deals and acquisitions. And a lot of these podcasts that they're largely geared towards the acquisition side, right? But I think there's so much more beyond that, right? There's how do you scale a business? How do you hire right? How do you have the right culture? How do you grow this thing effectively, right? How do you adopt your strategy with the changing market environments, and how do you make sure the team is all working together synergistically to grow at the highest level, right? And we've inbound calls all the time from insurance and vendors and accounting, right? And it's this constant. You constantly are juggling a number of objects, and I think that keeps it fun. But it also takes a certain, you have to be okay with that. And I think you also have to be okay with a certain level of kind of the ambiguity of, what's to come and everything else that is going around you.
Yeah, absolutely. It's just like, you're starting a business, and, you're wearing multiple hats, and, things change. Like you mentioned that you guys are getting calls from insurance guys and different things. And sometimes things happen at your units, and you got to handle it. And then you got to deal with new investors, and then you guys are doing education. So it's like a lot of different things. And then you're ultimately concentrating on building the business and, implementing different strategies there. So I could definitely see you wearing multiple hats. But you had mentioned that you do a lot on the acquisition
Yes.
side.
Yep.
I understand that you probably get like a lot of deal flow from, just being very present out there in the marketplace. So I'm pretty sure you see a real handful of deals. Is there a process that you take to see to take it from a 30,000 foot view to say, this is our criteria, this is not, in order so you can kind of focus on the deals that you do want to pursue?
Yeah, that's a great question. And I'd say there certainly is. For us, I like to picture it like a giant funnel, right? You start wide and it gets narrower as you go. We try to look at, I would say we look at roughly a deal every other day or so. Yeah, as far as deals that come across our desk, we have them come in from all around the country. A lot of them on the market, but we also have a lot of close broker connections that send us off market deals, and those usually have a little bit of a higher chance certainty of being able to make sense of. But on average, you might want to look at 125 deals or so to be able to find one that works. There's usually a lot of sifting through it, right? And you're not going to go and spend 2 hours on each of these 125 deals. Otherwise, you're spending 250 hours and you're not going to have time to do anything else, right? So for us, it's really about starting wide. When I say starting wide, it's starting from a very macro perspective. Let's look at the market, right? On a market level, is this a place we want to be? Well, we could even look at it, is this a country we want to be in, right? We know we're only in the States, but then it goes into, well, is this a state that we want to be in? And then it goes into, is this a city within that state that we want to be in? Is this an MSA that we want to be in? Is this a market that we want to be in? And then you get more granular and you start to break down into the submarkets. So once you've identified the market, then you're going into the submarket itself. Then so a lot of deals you're going to say no to just because purely off the fact that it's not a market you're interested in, right? You want to have somewhat of a narrow focus. You don't want to be too narrow focused. You want to be able to make sure you have enough opportunity coming through to run a business, but at the same time, you want to have narrow enough focus to allow you not to spin your wheels and then later just remind yourself that you don't want to be in that market. So know your market, I think is very important. And then potentially more important is knowing the submarket and doing your homework on the submarket within that market and knowing what you're likely to run into in the market, because most markets actually have good areas, right? I think oftentimes we judge a market just based on the name of the place, right? If you're, say, here in the Southeast, a lot of the stuff we look at, you hear Nashville, you hear Atlanta, you hear Orlando, right? And you hear these markets and we all get excited about it and we think it's going to grow so much. Mm-hmm. There's definitely pockets in every one of those markets that you don't want to touch. Just because it's there does not mean it's going to be the best spot to invest into. You might be able to have someone go buy it off you at an inflated price because they're going to feel the same way and they're going to oversee it. But I think you always have to be paying attention to on a more granular level what the submarket is. Where do the people work? What are the income levels? One of the first numbers we look up is the median income on the specific property on a census tract level. If you go to FFIEC or just Google FFIEC median income, you can pull up the calculator there, and it's a great tool to be able to give you a better sense on what the area's income is. Look at the crime rates, look at the schools, identify, is that a submarket you want to be in? I think the market stats, I mean, we can hit on some of those, but for us, we typically want to have over 100,000 people in that market. We typically want to see positive numbers in terms of job growth, in terms of population growth. We typically, like for us personally, we self-manage. So we want to stay here in the Southeast. So we're not going to go look at markets that are over on the West Coast just because a deal pops up. So for us, it's something that is relatively simple for us to be able to travel to, whether it's a drive or a quick flight here in the Southeast. Has enough of a population to be able to just allow us to give us some scale, has enough inventory to achieve some scale and overall just has positive basic fundamentals. So market, then submarket, and then lastly, we're gonna look at the physical property level. The physical property level is gonna start off, does it have flat roofs or pitched roofs, right? I won't say no to a deal just because it has flat roofs, but it's not going to weigh in good, right? It's gonna put some bad weight towards it. So if it has flat roofs and it's in a rougher area, maybe one by itself isolated wouldn't have been a deal breaker, but because it's got the two of them, we're gonna count it out, right? So then you want to look at the physical components. You want to look at how much deferred maintenance is in place. What is the HVAC system like? What is the year that it was built? And you want to make sure that all the physical attributes of the property align with your own strategy. Is it a condo, right? How is the financing going to work on it? Is it a scattered site? How are you going to manage it? Is it big enough for you to manage? Is it too big for you to manage, right? So you want to go through and get clear on some of these things. And note that we spent a little bit of time here, but we still haven't even touched on the part that everyone thinks about when you think of underwriting. The first thing that pops in your head is usually an Excel sheet, right? Where you're thinking about getting to the cash on cash. But you really need to make sure these things check out. You cannot just get lost. If you want to just chase yield, there's plenty of markets that I would never want to be in that will provide you with yield, right? If you're just looking at the spreadsheet, you're selling yourself, you're not doing anything good for yourself, right? Because you're going to get lost and chase after these things that look good on paper just to experience the effects of being in a bad market or being in something that's declining, right? It's like any kind of a business. The reason that it's at a lower price is because it's probably less attractive oftentimes, unless you're able to be the one that's the opportunist that spots it at a lower price as it's going up. And that's where you really make great deals, is when you can see something like that.
Yeah, absolutely. And that's some very good tips there. And then you guys most of your portfolio is primarily in the Tennessee, Georgia markets. Is any other?
We're in Tennessee and Kentucky right now.
Kentucky.
Yeah, we have about 1,000 units here in Tennessee and a little over 500 up in Kentucky. And as far as where we're targeting various markets: Tennessee, Kentucky, Carolinas. We like North Florida. We like Huntsville, Alabama. So there's a number of markets that are on our radar. Anyone that we do move forward with, we plan to scale and to grow more of a base in those markets. But we like to keep a little bit flexible in terms of the markets that we're looking at, just because there are a lot of really great places to be in here in the Southeast.
Yeah, I like that a lot. And then you had mentioned that you guys also self-manage your portfolio as well, or do you guys?
Mm-hmm.
Oh yeah, so
That's
that
right.
give you a lot more control, and then of course able to kind of squeeze out some more, profit out of the deal.
Pros and cons, right? If you're going to self-manage, yes, is it a profit stream for you? It can be, right? However, I would say you should really do it more for, like the first thing you said there, the control aspect of it, because it's a lot of work. It is a lot of work, and every one thing that you say yes to, you're saying no to a lot of other things. And if you say yes to management, you're saying no to a lot of other things, most likely in the beginning, especially, right? Because you have to create this whole other business that's very hands-on, that never sleeps, and you have to be very actively on top of that. So it's just something that, I think has pros and cons. I love the fact that we have it, because it makes us much more in alignment when we're underwriting deals. We're here in the office, and we have a lot of our area managers and property management in here all the time, right? So we're so in sync with them. We're going through budgets together. It's not just an investment company communicating with this separate entity that has their own separate goals. The alignment is all there. We're all meshed in. We're all tied in very tight. And having that in syncness allows us, like you said, to take better control of the deals, to be able to turn things around faster, to be able to catch problems and diagnose a little bit more effectively than we could without it. However, early on, it also might limit you. We're not going to go do a deal in Phoenix, for instance, even though there's probably there could be good deals out there. We're not going to go on the West Coast because of the fact that we're self-managing, and we don't want to be flying out there. And it's easier to get everyone together when you're in states that are a little bit adjacent to each other, and it's a quicker flight and quicker drive to be able to get around, right? So it also means that if you're going to enter a market, you need scale. You cannot go after deals that oftentimes are less than 50 units, because you need to have on-site personnel to be able to take those kind of deals on until you have some serious scale within that market. So there's pros and cons, like anything else, but I think if you do it right, it can be a phenomenal thing.
Yeah, you kind of answered my next question. Was kind of see what the mixture portfolio, I'm assuming, is probably 100 units, or unless they're clustered together, are part of like a portfolio of properties that you have in that.
So
that area.
the early portfolio that Jake and Gino were purchasing is a mix. They started off with a 25 unit, and there's a number of smaller unit properties, but that's because we have such a good base here within the Knoxville market of just property management team. So we can afford to have some people that are floating between different properties and have these kind of this scattered site makeup, which is really hard to operate until you have a certain level of scale. But so that is actually a mix. But currently, anything out of the Knoxville or surrounding markets, we are targeting only 100 plus unit buildings. Or if it's newer, it can be a little bit less. It just has to have the economics to be able to support at least one on-site office manager and then one maintenance on site so that we can run it with full-time employees.
Mm. And can you kind of take us through maybe your favorite deal that you guys did, or maybe your latest deal, to kind of give an example of the stuff you guys are working on?
So yeah, happy to. So when it comes to deals that I've done, like I've done 3 syndications and 3 deals that were not syndications. I think when it comes to the stuff, and a big question that we get asked is, why would you not syndicate it, or why would you syndicate it, right? Kind of one of those things. What determines the route you're going to go with that deal? When it comes to that, usually the stuff that was syndicated was for some kind of a specific reason. You know, for instance, one was a seller finance deal where pretty much the entire deal was financed by the seller at a 5% interest rate. We don't have investors that would be comfortable lending their money out at a 5% interest rate on an equity investment, right? But in the seller financing instance, that's a much cheaper cost of capital. It just makes sense, right? Another one that we had was a super opportunistic deal here in Knoxville that we've still been reinvesting a ton of money into and did not see any cash flow for over the first 12 months. So it would have been very tough to manage investor expectations, because a lot of times these heavier renos take longer than you initially anticipate, and sometimes more capital, and we didn't want to go back in for capital calls. So that one's worked out to be very well. It's done well so far. We're starting to get to the point where we're climbing into the green, and the asset value probably will double in terms of the per door cost, because we bought it at such a low cost per door towards where it is now, buying it at 24 and seeing where it lands. It could definitely be up to double what we were initially in at. And then with our syndicated stuff, I'd say that we have been a little bit less, a little bit more risk averse, I would say, because we're dealing with investor money, and we really want to be very thoughtful, because the worst thing we could do is offer investment, even though we know there's risk involved. We just don't want to do anything that we would lose investor money on. We want to find something that's going to be able to produce a nice steady yield. We want to put strong financing in place. Every deal that we've worked on with investors has been long-term fixed rate financing in place for 10 years, or in some cases more. So we're locked in with very strong non-recourse debt in place. We have yields that we typically anticipate to hit the 8% mark across the board. We offer the investors an 8% preferred return. And then we typically are targeting about a 15 IRR on each deal. The last indication we've done is out in Lexington, Kentucky, and that was very, very simple deal. I think you don't have to find a deal that you don't have to solve this major problem all the time to be able to create a good return. You just have to buy it right. You have to know what you're looking for, and you have to stick to that. And in our case, it was a time-sensitive deal that came across our plate through a broker. And we realized that we like the price that we're going to get in at. We felt that if it were to go to the open market and be a little bit less time-sensitive, it may have gotten bid up a little bit more. So we felt like we bought it right in the first place. And then we saw that there could be some improvement in terms of just the customer experience on the management side. And there also could be some improvement in terms of some of the interior improvements across the board, putting in new flooring, getting rid of some older light fixtures, and fixing up the cabinets and things like that. So in this deal, is a perfect example of something that we're buying. It's already 90% plus occupied. It's already doing a pretty good yield out the gates. Maybe it was doing, I want to say it was doing the equivalent of 7% or so out the gates. We're already, we've increased that a bit. We've put less than 4,000 a unit in. We've actually still have a lot of our money raised, because we're still kind of slowly using our CapEx budget towards improvements, because we really have been able to see improvements in terms of our income and performance without using a ton of it. So it was really a pretty simple deal, right? And I think that we like that. Oftentimes, if we can find something that's simple and produces a return that is a nice yield with strong potential for appreciation. This is in a great location next to a lot of new built retail and kind of live, work, play area. If you buy something that's simple like that, it can really perform for you for a long time. So I guess it's a message that I've learned through experience. Sometimes, the complicated stuff is attractive, right? Everyone wants to look like the superhero that developed the next skyscraper, and built the trophy asset and bought the trophy asset and completely redeveloped it. Sometimes those things can be more for they're more attractive from a publicity standpoint than they are from a return standpoint, right? You can actually do things that are not sexy and
Mm-hmm.
that are pretty basic that actually allow you to achieve some very good risk adjusted returns.
Yeah, it seemed like you guys have like you had mentioned like the simple, straightforward type of model, but you had mentioned, 'cause I know your mantra is buy right, finance right,
Yep.
put down the long term. So is it more your investors go to you guys because you guys are going to be into these deals, long term, or is it because I know other operators, they have like a 3-year business plan where they're maybe
Yep.
trying to flip it into something else, but you guys are just, since you guys have property management place, you guys have, strong presence in that marketplace. Is it more of a long-term play for you guys?
It's good timing in terms of starting that conversation because it is something we're leaning towards, right? When you look at this company, it was started off the base of buying assets that at a rate that's going to be able to produce a nice yield that's below replacement cost, that we can hold for the long term. And as we've brought in investor money, we've really done it in a very kind of standard, I want to say standardized strategy for what a lot of the, I like to call the retail at your kind of your everyday investor has access to, right? A lot of the 50K plus investments. We've really offered it in the model that most people are used to seeing of a profit sharing model with a preferred return and the intention to sell after 5 to 7 years. So we've been a little bit on the longer side. We haven't been promoting 3 to 5 years or anything like that, but we have been promoting the intention to sell. However, I think for all of us, we've had recent discussions about how can we provide investors with a vehicle that is going to give them the true benefit of multifamily. And when you look at multifamily as an asset class, yields can be okay right now. We're at a high point in the market. There are other asset classes that can produce better yields in the short term. The ability to add value can be pretty good. I'd say it's strong suited there, but there are other vehicles you can do that, other businesses you can buy and add value to. But I think the one thing that you and I, and I'm sure most investors that are in this space can really all agree on and be confident on is that it's here to stay. People are going to be living in apartments. It's not going anywhere. Our long-term confidence in this as an investment is very, very high. And there's very, very few businesses or even industries that you're going to feel that same level of confidence in betting in, right? You can invest in an index fund, sure, because there's always going to be, we expect the stock market's probably going to be here for the next 50 years. We don't think it's going to go anywhere, right? But if say you invest into the S&P 500, I bet those 500 companies, there's going to be a lot of fluctuation, right? There's a lot of companies that are going to be dying out and going off and new ones that are rising to the top within the next 50 years, right? And if you look at just industries as a whole, you look at the automotive industry, right? You're going to see that get completely disrupted. We're in the brink of that with the electric cars, and it's going to be self-driving cars, and a lot of the leading automotive manufacturers right now, they may not be here in 30 years, right? They may not be able to keep up with the change and adapt quick enough. And but what we do feel comfortable about is that people are going to be living in apartments in 30 years and 50 years from now, right? And maybe they're going to go through several different transformations. Maybe there's going to be a lot of smart technology in place. Maybe the way that we live our lives is going to change dramatically. But I think that we can all agree that there's going to be some type of an apartment where people are going to live. All of the shifts and demographics are pointing towards being more of a renter's nation. And we don't really expect that to stop. I'm even hearing more and more talk about the idea of people actually developing entire single family communities to allow people to live and rent in, right? It's not something that we're currently or personally looking at right now. Really haven't researched it heavily yet, but I've heard at several different events, the best part about going out to different events is that you get to hear what other people are seeing in different parts of the country. And one thing that's came to my attention I'm hearing more and more of is that people are literally building single families just for the idea that people are going to want to rent them, because maybe millennials that have decent income jobs, instead of going through all the hassle of mowing their own lawn and doing their own maintenance, they'd rather live in a community that has full-time maintenance on staff that can mow their lawns for them, that can take care of things when things break down, that can replace their water heaters, instead of having to outsource these things and figure out who do I call and how does it get handled. So I don't know if it's going to work, but The fact that we're even considering that is kind of wild to think about, versus I think 10, 20 years ago no one would have been having this conversation. But just the fact that we're shifting into more of a renters nation is something that I think we can all see as clear as day.
Absolutely. And as far as kind of like your company, I know again, multifamily, absolutely. I know you had mentioned just like, if you guys found a deal in Phoenix, is something that you won't be jumping on
Mm-hmm.
today, but is there any future plans? I know you have a huge, educational platform, but is there any other markets that you would maybe consider in the future that you guys just maybe discussed possibly?
Yeah, so for us right now, we're still very young here in the Southeast, so we're really just letting our roots grow here as much as possible. So I could see us expanding throughout the whole Southeast. I could see us growing into a very strong player in the Southeast. And I think in terms of how we go about doing that and our strategy, I think I could very easily see it being something along the lines of what you had just asked about beforehand, is us, if we can find a way where we actually bring on investors, we return all of their capital to them in the first 5 to 10 years or so, and then we keep these assets long term, and they stay in the deal with us and receiving an ongoing profit share and equity build in the background after their initial money is no longer at risk. I think that something along those lines would be phenomenal, and I think it really plays to a large point of the fact that we self-manage, because with our management systems and constantly improving that and constantly being able to control these assets and take good care of nice quality assets, some potentially stuff that's a little bit newer than what we've done in the past, something that's in good locations. I think that the combination of those as a whole would allow us to really build some serious economies of scale that would serve us well.
Awesome. Yeah, to learn a little bit more about you, what's kind of your typical work day, and do you have any special morning routines?
So my typical workday is that there is no typical workday, which is what I love about this space, because for me, I am not completely rigid, right? I'm not someone that I just want to check in and check out the same time every day. I think every day in this space, some days, past few days, for instance, have been a lot of scheduling meetings with brokers, a lot of broker interaction, a lot of front end underwriting with deals and negotiating. Sometimes I have entire weeks where it's all playing defense and working on the asset management systems and working on different things that we're working on with establishing relationships with vendors or onboarding new team members, right? So it really shifts a whole lot, but I think it's all about just prioritizing and making sure you're not dropping the ball in any one area. So I do a lot, instead of having it more to where I have specific times that I'm doing things. It's usually, if I'm not in a meeting, I usually have more specific tasks laid out for what I want to do it throughout the entire month, and which days I want to get them done by, and kind of deadlines, and then fit in based on how my day kind of rolls out. And then when it comes to morning routines, I try to wake up at 6 a.m. every morning. I'm pretty consistent with that across the board. Getting in a little bit of reading, meditation, those are always the best for me. I kind of fluctuate. Sometimes I do the gym more at night. Sometimes I get in a good rhythm with doing that first thing in the morning. But I've always had some kind of a morning routine over the last 5-6 years. And I definitely am a big believer in it. I think for me, I switch it up every few months.
Awesome. And what you could say that you're most grateful for?
Most grateful for, well, I think it's hard not to think about the business and the space we're in just after this conversation. But I think when I think about most grateful, I like the fact that I'm in a position where I get to deal with a lot of challenges. I think that for me, that's the stuff that excites me, is looking at challenges and looking at things that are not really optimal, and getting things thrown at you that kind of test you, and having to persevere through that. I think that it builds character. I think that it makes you see the world through better perspective. And I think that's how you grow the fastest, is when you're in it, right? And I think I'm just very grateful that I'm not in more of a kind of a monotonous position where I'm not seeing, where I can't see the bigger picture, or that I can get kind of complacent or in a kind of comfy position. I like the fact that we're constantly evolving and adopting, and it's just a fun thing to do. I thoroughly enjoy being in this position.
Awesome. I know we have your website for Rand Partners. Is any other contact information you can share with us?
Yeah, you can reach out, randpartnersllc.com, also randcre.com will give you a better view on the whole family of companies as a whole. We have a lending division where we finance multifamily loans for different investors out there. We have the investment group at Rand Partners. We have Rand Property Management. And then we also have Jake and Gino have an education platform set up. And we also have Rand Cares, which is a charitable branch. So we have, we call it a family of companies there. If you want to get more information, you can feel free to check that out. If you want to reach out to me directly, if you have any follow-up questions or anything else, I'm on most social media platforms. And you can also shoot me an email at Dylan, DYLAN, @randcre.com.
Awesome. Dylan, it was a pleasure to speak with you. Happy New Year. Best of luck for the rest of the year. Look forward to connecting with again soon, and have a great week.
Cool. Thanks so much, Dwayne. Great being on the show.
All right. Thank you,
Thanks for joining us on this episode of the Wealth Through Real Estate Investing podcast. Don't forget to subscribe and leave us a review on iTunes or the listening platform of your choice. Also, please check us out at DwayneLClark.com, as well as find us on Facebook for more useful content and resources.